In this episode, we're going to be talking all about volatility, what it is, what it means for the market, and what it means for your trades. So we started on the charts, but we're going to hop onto a quick slideshow for 5 minutes so I can teach you all about volatility. So the definition of volatility is it refers to the degree of variation in the fluctuation of the foreign exchange market over a specific period of time. So if we move on, key features of volatility are the magnitude of the price changes, which in simple terms mean large movements, large price changes could incur large profits. The speed of the price movements, which is how quickly the price moves from a set point to this next point, from A to B, how quickly that moves, and market reactions, how the market reacts during news, uncertainty, different economic unbalance, making it more volatile. The importance of volatility in trading is that there's opportunity for profit, meaning you've got such a big wide range of price movements, you can capture small wins the whole way up or a big win. So you've got a lot of opportunity for profits. Your risk management when trading in high volatility has got to be very tight. You want to decrease your risk because price moves so much it can easily stop you out. However, in the same breath, you want to keep your risk wide enough so when price is spiking up and down, it doesn't stop you out. We'll learn more about that later on. It's going to influence your strategy, meaning you're going to have to change to more of a momentum strategy, which I'll teach in other episodes. Strategies are a whole different subject. You're going to want to change to a momentum-based strategy to catch that high-flowing, high-moving prices. And you've got more trading opportunities, meaning in a given time period, the price has moved more than in high volatile environments than it would do in a low volatile environment. Heading back to the chart, I'll show you exactly what I mean when I say volatility has a massive impact on how you trade. On the chart in front of you, I've shown you two different highlighted rectangles. One of them is a 6-hour period and the other one's a 3-hour period. Now, if you read what I've written down, you may see 15 and 30 pips thrown underneath. Now, as a quick explanation, pip stands for percentage in point. So if you take your eye to the right of the screen here, you can see this 1.03059. The 5 in 1.03055 now is the pip. The 7 behind it is the 5th decimal place, and that's what's called a point. A point is a fractional pip, and TradingView use it to show intra-pip movements. We'll focus on pips at the moment. Pips are the 4th decimal point. So if you count back from the decimal point here, you've got 0, which is 1, 3, 0, 6. The 6 is your pip. So as we've been talking between me and you at the moment, it's gone up by 1 pip, from 5 to 6. So this is what I mean when the highlighted rectangle here says it's moved a total of 15 pips. From the top of the rectangle to the bottom is 15 pips different in the chart. So let's take a look over here. This 6-hour period moved a total of 15 pips. This 6 hours was from 25 past 8 in the evening to 2:35 in the morning the next day. Volatility changes throughout the day. So as you can see here, overnight there wasn't much volatility. It's a clear difference between 25 past 8 and 2:30 in the morning to that of 6:45 and 10:15 in the morning. In this 6 hours, the price had only moved 15 pips, whereas in the 3-hour period, not long after this morning, had moved a total of 30 pips. So in half the time, it moved double the amount. If we zoom out, we can take a larger look, as this is on a 5-minute time frame. So this moves based on anything like small market changes, any uncertainty in the market, and the biggest thing that affects these smaller time frames is timing. Let's take a look at a larger 4-hour chart and see what volatility looks like on a larger scale. Here I've loaded up a 4-hour chart with 2 different highlighted rectangles. Now for simplicity's sake, I've kept both these rectangles 3 days long. So if you can look over here, this rectangle starts here and ends here, and it's 3 days and 4 hours long. If we go over to this rectangle over here, it's going to be the same. Stops there, 3 days and 8 hours. Sorry, so I can change this. I'll move this in by, there we go. It doesn't really change much. So this period here was a period of low volatility, whereas this period here is a period of high volatility. This 33 pip move in 3 days, it started on the 23rd of December, goes all the way through Christmas Eve, even into Christmas Day, where there's not many people trading the markets, meaning there's not a lot of volume in the markets to push price in either direction. Whereas here, on the 30th of December all the way till the 2nd of January, even though you got a bank holiday in between this large gap here, you can see the volatility was a lot higher because there was a lot more people in the markets. Starting from the 30th of December all the way till the 2nd of January, same 3 days there was prior in Christmas Day, the price moved 157 pips in 3 days over the 33. Now that's going to make a big difference when it comes to your trading. It's not just Christmas Day. Christmas Day isn't the only day that affects the markets. If we zoom out even more, you can see that just by taking a quick glance, you can see times of slow and times of fast moving price increases. Take a look at this chart. It's the same chart as just a bit further back, still on the 4-hour time frame. As you can see here, you can see it clear as day, starting from here all the way to here. This took 13 days and 8 hours, and the price moved a total of 166 pips. That's 13 days of movement for 166 pips. Now, if we take a look at the day after, that's 166 pips right there. That's 4 hours. Let's call it 8 because there was 2 candles. So in 8 hours, over 13 days, the price moved the same amount. When trading in high volatility, you've got so much more space to catch trades in the direction you want it to go and keep your stop loss tight, and you take profit quite large, and you can ride it out a lot quicker than if it would be in the markets of low volatility. The biggest issue I see when coming to volatility and why people don't make the most use out of it is they don't ride the wave completely. They will ride a low volatility wave for 4, 5, 6 days sometimes and catch one trade, whereas in 2 days they can be catching 12, especially on a day trading setup. If you can catch those 12 trades and you've got a consistent setup and a consistent trading schedule and a higher probability of securing a winning trade, those 2 trades over 6 days you've placed, even if they both won, so you've made 2%, so that's 4% on total. Let's say over 2 days you've won, out of 12 trades, you've won 8 and you lost 4. In those 2 days you made 12% profit, whereas in those 6 days you made 4%. In those 2 days you made your 12% profit by winning 8 trades at 2% each, so that's 16%, but then you lost 4 at 1% each, so that's 12% profit in 2 days, rather than having 6 days of low trading volume and low volatility, but still getting the 2%. The biggest advantage you can have as a day trader is to find these high areas of volatility and use them until they run out. As I said in the last episode, you want to squeeze out as much possible ROI in every trade. So why wouldn't you use every second of that high volatility to secure yourself as many wins and as many trades as possible? That's the basics of volatility. In the next episode, which will be launching later today, or 2 on the same day, I'll be talking about liquidity, which is in the same hand as volatility. So I'm just having them as 2 separate episodes to keep them separate, but they're both releasing today. So I'd like to thank you again for watching. Hit the like and subscribe button so I can keep posting these videos. And as always, I'll see you tomorrow.